Have you ever found yourself in a situation where you're debating whether to invest in something for your business, like that fancy new espresso machine for the break room? You think it'll keep your team caffeinated and productive, but then you wonder, is it really worth the money? That's where cost-benefit analysis comes in. Hi, I'm Randy, and welcome back to Managing Your Business by the Numbers. Today we're going to break down what a cost-benefit analysis is, why it's important, and how you can do it yourself. No accounting degree required. So if you're ready, let's begin. So what exactly is a cost-benefit analysis? Well, think of it as a way to weigh the pros and cons of a decision, but with numbers. Imagine you're considering buying a new machine that costs $10,000. This machine promises to save you $2,000 a year in labor costs. Naturally, you'd want to know, is this machine really worth it? Well, that's where the cost-benefit analysis steps in. Let's break it down even further. If you're spending money, that's your cost. If you're gaining something in return, that's your benefit. The idea is to make sure that the benefits outweigh the costs. If not, you might want to rethink that purchase. Just like when you realize that a $6 latte every morning might not be the best investment for your future, unless it comes in a gold-plated cup. A cost-benefit analysis helps you see the financial impact of a decision before you commit. It's like having a financial crystal ball, but without all the mystical fog. By understanding the numbers, you reduce the risk of making a bad decision, and you can prioritize projects that actually add value to your business. Think of it as a way to avoid chasing shiny objects that might look cool, but might drain your wallet. Like when you're tempted to buy that ultra-modern office chair with the built-in massage and heating. Sounds amazing, but do you really need it? Let the cost-benefit analysis decide. All right, let's break it down into simple steps. Don't worry, I promise it's easier than finding the TV remote after your dog decides it's their new chew toy. First, you need to identify all the costs and benefits involved. Costs can include upfront expenses, ongoing costs, and opportunity costs, what you're giving up by choosing one option over another. Benefits, on the other hand, can be direct revenue increases, cost savings, or intangible perks like happier employees. For example, let's say you're thinking about launching a new marketing campaign. Your costs might include $5,000 for advertising and $2,000 for graphic design. The benefits could be estimated $10,000 increase in sales, and maybe even a boost in your brand's reputation. Though that's a bit harder to put a price on, unless you're a PR wizard. Next, you'll want to assign monetary values to each cost and benefit. Even those intangible benefits can sometimes be translated into dollars. For example, if you expect a 20% increase in customer satisfaction, you might estimate this could lead to an additional $1,000 in future sales from loyal customers. So in total, your costs are $7,000 and your expected benefits are $11,000. If you're like me, this is where you start getting excited because the numbers look so good. Now subtract the total cost from the total benefits to find your net benefit. In this case, $11,000 in benefits minus $7,000 in costs gives you a net benefit of $4,000. That's a positive number, which means this decision could be a winner. But just remember, just because the math works out doesn't mean you should dive in head first. Consider other factors too, like timing and market conditions. And maybe run it by your dog too. They've got good instincts. Finally, analyze the results. A positive net benefit is a green light, but don't forget to think about the bigger picture. Like what happens if your sales projections were a tad too optimistic? Here's the best part. This isn't math that's going to make your head explode. If you can add, subtract, multiply, and divide, you're good to go. And if you're not a math person, no worries. There are plenty of tools out there like spreadsheets or apps that can do the heavy lifting for you, so you can keep your focus on running your business and not pulling out your hair. So, Should you do this yourself, or should you call in your accountant? For straightforward decisions, like our marketing campaign example, you can handle this on your own.
You can do it! You can do it! You can do it! You can do it!
But if you're looking for something more complex, like expanding your business or investing in new technology, it's probably a good idea to involve your accountant. After all, we accountants have a knack for spotting those hidden details that can make or break a decision. And trust me, we're not here just to make your spreadsheets look pretty. Let's talk about the pros and cons of doing a cost-benefit analysis. On the plus side, it helps you make informed decisions, reduces risk, and gives you a clear financial picture. Plus, it's a great way to justify that big purchase to your business partner or to yourself. On the downside, it can be a bit time-consuming to gather all the data. And there's always the risk of letting your bias creep in, like when you're really excited about the new project and you start overestimating the benefits because, well, it's just so darn cool. But hey, even a basic analysis is better than going into it blind. Think of it as your business decision insurance policy. There are different methods of cost-benefit analysis, each with its pros and cons. A basic analysis is simple and quick, but it might miss some nuances. A discounted cash flow analysis is more accurate for long-term decisions, but it requires a bit more complex math. And a sensitivity analysis helps you see the impact of changing assumptions, like what happens if your sales don't hit the targets. But be careful not to drive yourself crazy with too many what-ifs. Sometimes it's easy to get stuck in analysis paralysis, where you're spinning in circles without making any decisions. Remember, it's all about finding the balance. Finally, let's talk about sunk costs, those pesky expenses you've already incurred and can't get back. A common mistake is letting sunk costs influence your future decisions. Just because you've invested time or money into something doesn't mean you should keep pouring resources into it. It's like when you've eaten a half a pizza and you realize you're full, but you keep eating because you paid for it. We've all been there, but in business it's crucial to know when to walk away. To wrap it up, a cost-benefit analysis is a powerful tool to help you make smarter business decisions. It's not about complicated math. It's about understanding the numbers that drive your business. So the next time you're faced with a big decision, take a few minutes to run a quick cost-benefit analysis. You might be surprised at what the numbers tell you. If you found this video helpful, be sure to like, subscribe, and hit that notification bell so you don't miss out on future videos. And remember, understanding the numbers can help you make better decisions for your business. Now go out there and make those smart decisions. See you in the next video. And until then, have a great day.